Hey everyone, my name is Andy. My channel is Finding Value. If you like making money, click subscribe to the channel. We'd love to have you be with our community. We're a pretty nice community looking at stocks and potential opportunities for investments. Give me a thumbs up if you like this content. So I'm going to go over some questions here. I was looking through the questions, some excellent questions. Thank you for all these questions, and I'm going to respond in a video format so everyone can get the answer here. So this person's he says, I'm using a leveraged 2x ETF. For this one, I can't find a pure play natural gas company. My suggestion on that is be careful of the leveraged plays, the 3x, 2x type plays. They're playing with a bunch of futures and leverage out there. And typically what happens is those naturally, they asymptotically approach zero. Because of the decay that they have with the futures that they use to get the leverage. So I would avoid the leveraged uranium, silver, all those things because they naturally decay to zero. I just wouldn't play it that way. A pure play natural gas, I would use companies, maybe a couple companies, SWN, Antero Resources, which is AR, Crew Energy, that's CWEGF. Those are, to name a few, that are kind of more natural gas heavy that I like. You can choose whatever you want. You can use a mutual fund like FSNGX, Fidelity Select Natural Gas, something like that if you're doing it in a 401k. So here's another question. What kind of time frame are we talking on this bet? So the driver of everything is housing starts. Housing starts drive inflation. And when housing starts move up past the 1.5 million yearly demand for new homes, when it goes past that and works off the 3.8 million home shortfall that we have in real estate, we're going to go into what's called an expansion phase. We expand greater than the average. When we expand greater than the average, we have above average inflation because commercial banks are putting loans against brand new homes. Those loans against the new homes is inflationary, and it expands the money supply quite rapidly. The majority of money comes from commercial banks through the fractional reserve lending system, and that's where that expansion comes from. It's the real estate market. Now, delayed just a little bit behind that, gold and silver are going to move higher. It's done that every single time in history. In the 70s, it did it. In the late 70s, it did it. In the mid-2000s, it did it. And today, we're seeing housing starts ramp up into an expansion phase. So I'm expecting, and we have the perfect alignment of the commodities valuations being cheap at the beginning of the expansion phase here. It was at the beginning of 98 to 2000, and it was the beginning of the 1970s where we had these expansion phases and the valuations of commodities be cheap. And they all went into commodity bull markets. So I'm expecting this to go into a commodity bull market because the valuations and the alignment with the expansion phase of real estate all align just like in history for a commodities boom to happen. So now we're just waiting on prices to go up. So we're getting these pullbacks. I think, and in my opinion, is these pullbacks are buying opportunities because the conditions, the underlying structural market conditions are all in place for this to go on up. So the time frame is the housing starts and how quickly they build off that 3.8 million home shortfall that we have. Maybe it takes 5 years, maybe it takes 7 years, but that's our holding period. Now, this is what I'm looking for in this environment. An exit strategy is when we decline on housing starts and the valuations are high. When you have those two conditions met, we're out. We're out and we're rotating into bonds. Because when the housing market crashes, that's going to be deflationary and it brings everything down with it. So bonds will be the play at that point. It'll be high interest, it'll be higher interest rates, so we'll get paid higher on our bonds. The decline will happen. And then we jet out into bonds. And then eventually when this thing crashes and bottoms out, we go into real estate or we go into stocks because interest rates are going to go down. It's going to push our bond prices up, and then we rotate out. So that's the plan. Here's another one. I love the market updates. A lot of people like ratio updates, coalition portfolio, and the stock picks the most. So people want to hear my opinion on those. So right now we've got kind of a pullback going on in uranium. Some of the oil and gas don't look too bad. Looks like we're pulling back a little bit in copper, and in some of the we're pulling back in gold and silver, but that could rotate pretty quick. So the companies that I like are the ones with the very large chart patterns, the ones that have the decade-long plus chart patterns, because when those break, it's going to release energy. And that energy, it's being contained by the chart pattern, so to speak. And when you have an energy that's been contained for 10 years, when it breaks, that energy is going to go. And it's going to go somewhere. And it's going to go up very fast. And it's going to go up very long, because the bigger the chart pattern, the bigger the break, the longer the move, the bigger the move. So I like companies in the silver sector because they're all exhibiting very large chart patterns. Yes, it's out of favor right now, but I'm seeing strength in it. AG, EXK, FSM, Hecla Mining, which is HL, Mag Silver, those all look fantastic. They all have very over decade-long chart patterns that are about to break or have broken very recently. That's where I would put a little bit of my money. That's where I put the hypothetical portfolio money as well. So I like those very much so. The diversified miners, VALE, RIO, Rio, BHP, SOHUY, and Norilsk Nickel's right there trying to break out too. When Norilsk breaks, get in it. These other ones, I like those as well because of the patterns that they're breaking. They're all multi-decade-long patterns, and they're breaking to the upside. The home builders are looking fantastic. KBH, LGIH, Hovenen, HOV, and MDC Holdings, MDC. Those are all very solid companies. They're breaking massive patterns, all to the upside. I think those are probably pretty good to hold on to because they're home builders, and we have to build new homes in an expansion phase of real estate, and this is the time to own them right here, right now. Those other companies, TEL, GTE, all those companies are very good. So I would suspect that they're good long-term picks, just like oil and gas, natural gas, that is. Uranium, you just keep adding in and just hold on. I'm a buy and hold type of person. I'm not a person to buy, sell, and try to time the market. It just doesn't work. It didn't work out very well last bull market, and I'm not doing that again. So those are some of the picks. I'm getting a lot of questions on the Biden plan. Biden, I guess, outlawing drilling on federal land. All this is going to do is push prices higher. It's not a bad thing. It doesn't necessarily affect a lot of our investments. So what it's going to do is it's going to drive prices higher. If they're not going to build pipelines, if they're not going to do this, we already have a massive shortage that's about to develop, I think, in a year or two. And what's going to happen is it's going to spike. You're going to see this huge oil spike. It's going to be bad. It's not going to be good for anybody. When oil gets to $200, $300, $400 a barrel, no one's going to like this. Maybe it's delayed another year, a couple years past that. So maybe it's 2022, 2023, 2024, whenever it hits. Position for it, hold some in your portfolio, and just hold on. Tellurian, if you look at that, they're set up perfectly. We have a market deficit in the future on liquefied natural gas. It's growing. It's like boom, and it blows out. They're going to be hurting for liquefied natural gas on a global scale. They're in the right place in the right time with the right product. They're going to build their terminal. It's going to take a little bit. I'm in it for exploiting that deficit. We're going to see sustained higher prices. They are going to benefit. It's just I'm going to hold on to them. They've got great management. They've done it before. Hold on to the stock and just sit in it. I don't care if it goes anywhere for a little bit. Maybe it shoots higher. Maybe it shoots a little lower. I'm in it for the future and what they're going to put into place. I'm not in it just to make 100%. I'm in it. I want to be in it and see that $5, $6, $7, $8 per share cash flow that they're going to create for their shareholders. I got in for I think a very good price, drastically undervalued. I'm holding into it. Now, if you position size properly, if you put a few percent in each of these positions, I think you're more willing to hold on to things if they don't go up, because other things can go up at the same, at the same time that this other one's perhaps not going up. Or maybe Tellurian just shoots to the moon. Who knows? I can't tell you, I don't have the crystal ball that tells you everything. But position sizing and creating a portfolio that is sustainable and very robust against whatever, is thrown at us, I think is the key. Position sizing, getting in there, do your research now, and just hold on. If these companies have good management, if they have products that are needed in very much so greater quantities in the future, and even now, I'm in those companies holding on. And if they have very large chart patterns that are about to break, that are decade long, man, you are positioning yourself to win, and you just got to spread it out to reduce your risk, to reduce your volatility, to reduce all of those things so that you can be successful emotionally, financially, and be able to hold on to these things through thick and thin. If you're riding, in one company with 50% of your portfolio or more, you're probably not going to hold on. So, if you like this channel, subscribe to the channel. Thank you for leaving comments. Continue to leave more comments, and I'll answer your comments through video format, so everybody gets to get an answer from me about your question. Give me a thumbs up. Thank you for listening. This is Finding Value.